Hello everyone and welcome to our webinar, IFRS 15 and ASC 606, the auditors are coming. Are you prepared? My name is Pam Gaisley and I will be your moderator. Your presenters today are Deb Jelly and Dave Zaranin, who are both senior technical consultants here at Strafford Technology. I say technical because they know the Oracle Finance product lines inside and out, but they also know finance, which makes them great thought leaders in the area of risk and compliance. A quick glance at our agenda. Dave will begin with a brief introduction of Strafford and what we do. We'll then lead into the basics of the IFRS 15 and ASC 606 new standard and what some of the more recent compliance adoption statistics are. After that, Deb will get into the guts of the presentation and walk you through the steps you need to take to be compliant and what the impact of compliance means to your business. We'll wrap up with Q&A, and if any time during the presentation you'd like to ask a question, please use the question feature located at the right column of your go-to webinar interface. During the presentation, we'll also have a couple polls as well as an exit survey. Please participate. Your feedback is really important to us. I know it will be asked, so I will answer it now. Yes, the presentation will be recorded, and we'll share the recording with you. Plus, we'll be sending a certificate for you to claim 2 CPE credits for attending the presentation. And with that, I'll pass the presentation over to Dave.
Thank you, Pam. So we go to the next slide. So who we are. So Strafford has been in business for 22 years. We started out as a BI company back in 1995. So who we are today. So basically, we're a thought leadership in the finance area. We do finance implementations. We specialize in enterprise performance management, or ERP as the acronym is called. And we do a lot of consulting services. So we do specialty in BIs where we started. We've done over 450 projects to date. We're a platinum Oracle partner, so we work closely with Oracle and a lot of their products. Our primary focus is finance. We focus around, we'll call it the office of the CFO, so anything finance related. That's our specialty. And also our success rate is at 97%. So how do we measure success? Basically, we call a project successful if we're on time and on budget. So that's how we measure success. Next slide. So let me just start with the off to the left side here. So our services. So we do a lot of the basic implementation services, upgrade, migrations to cloud, health checks. So we partner with Oracle, we do the implementations, and we have a whole group of folks that work on that. And then moving over to the top right side, we also have strategic services. So we'll do things like finance transformation projects. We'll do evaluation, assessments. We'll help with roadmaps. So we have a whole practice related to the high-level strategy section. And then moving down, we have support services. So once a lot of our customers, after we implement them, have them up and running, they're happy. They like the consulting team. They like ongoing support. So what they can do is have, staff services. So if there are questions as the implementation and as things go, or if they have staff turnover, we can quickly go in, we're familiar with their app, and then help them get through that process. And then our fourth main breakout we have is we do hosting of applications. So we'll host a lot of the Oracle products, the consolidation, planning, budgeting. We're fully SOC compliant and everything else. Okay, next slide. So again, moving from left to right. So our operational finance. So we do everything. We do everything under the sun. I mean, so we have folks that specialize under general ledger. So we can go into companies and help them set up their general ledger and any other questions that they may have. We have different consultants that do planning and budgeting. We have a number of folks that are really strategic in setting up the driver-based planning information, as well as the other profitability and other stuff. We have financial close and reporting. That's my specialty. So what we do is a lot of times we help people go in, install their financial close, and then help them shorten the close process. So that's one of the things we do. And then the business intelligence services. We have a group of folks that will, do everything from data warehousing to dashboarding and helping you, the CFO and the different groups come up with what's important to them and the metrics that they need. Okay, the next. So what makes us successful? So the unique thing about Strafford is, I don't want to say we're a bunch of older guys, but we've been around for a while. So like myself, I was an accountant for a number of years, worked as international accounting. So I understand the business as well as the technology. And one of the things that we do a little bit different is we do what we call an agile approach. So we'll do, we'll build things, we'll show the customer. We're not going to just do something and then here it is. So, we leverage our relationship with the customer a lot. And then we're always looking at the latest technology. So we're aware of who's doing what and whatnot. And then, like I said, myself, I've been doing this for over 25 years. So we have a lot of consultants that have a lot of good, I'll say, war stories, industry experience that we can that we share with our customers. So that's just kind of a quick wrap up of who we are. And next slide. And then this is just some of our recent clients. So this is just like within the past year. So this isn't, this is all we do. So anyways, so basically what I want to do now is turn it over to Deb, and then you'll hear me a little bit later giving you some more examples about this IFRS 15 and ASC 606.
Thank you, Dave. So my name is Deborah Jelly, and like Dave, I have a few gray hairs on my head as well. We have a great deal of experience in Strafford in the business process and financial processes area. And one of the things that we have noticed is the impact of various standards on some of the throughput for our systems that we implement. And we decided to put together this webinar to address one of the impact of the standards on the applications that we look at. And we felt this would be very useful for us to do this. So we wanted to know if you were prepared for the revenue standards change. It's not just a back office issue, as we've noticed. It impacts sales, marketing, compensation for sales and marketing, contracts, pricing strategies, and your tax process. Now, please note that the timing of sales commissions may be impacted, but it's really a management decision. The marketing incentives, the timing and calculation of them is also a management decision. So the standard does not directly require compliance in those two areas. So therefore, compensation can be impacted, but only if you as a company decide that the sales and marketing adjustments would impact compensation. Where we see a lot of the impact is contracts, pricing, and taxes. Looking just a little bit at contracts, those tend to be very unstructured from a system perspective. Your system needs to actually deliver more system data friendly information around your contracts. In addition, pricing strategies can use bundles and giveaways, but it will need to be able to be unbundled and allocated to the system. And finally, your tax process will need to be further split between cash and accrual basis. So we're going to be looking at each of these areas that are directly impacted by the revenue standards change. Move the slide forward here. So a brief history of this standard that has been applied. it was basically issued in May of 2014. So most of you are probably already working on this. And it replaces IAS 18 and 11 as well. It's consistent with 605 for ASC under US GAAP standards. So by establishing comprehensive principles, the board hopes that preparers around the globe will find revenue guidance easier to understand and apply. The bottom line is that rules on revenue recognition have not been strong enough, so the accounting gurus know this, and ASC 606 is the answer to that financial challenge. Please note that application is required for public entities and needs to be adopted beginning after December 15th, 2017, which is already passed, but this webinar is looking at to make sure that you are prepared. And if you are on a variable fiscal year, the annual period's beginning after December 15th, 2016. So you should be already working on this. So the summary of the new standards really follow the evolution of the revenue recognition standards over the years, in that it better matches period revenue and equity with period expenses and obligations. So you're going to be dealing with revenue recognition timing for your contracts. You have to match the contract obligations to revenue within a system, a process, and also you have to issue quite a few more disclosures than you may have been issuing in the past. There will be potentially a reaction by the market to these restated numbers, and we'll go into this in a little bit, a couple slides down. However, as I noted earlier, there is no requirement to alter your compensation plan, since these are management decisions. However, based on the fact that you want your salespeople to comply, it might be a good idea if you look at your compensation process. Pam?
So now we have our first poll. The first poll is, how ready do you feel your company is to file under the new IFRS and ASC 606 standards? Your options are: we are ready and automated, we are ready in using spreadsheets, manual efforts, we are still planning how we will handle it, and last but not least, we have not started planning. And for you shy folks, you can always say, I'd rather not say. Most of you are still planning. So 58% of you said that we are still planning for how we will handle it. So this is a great webinar for you. And 26% of you said that we are ready in using spreadsheets and manual efforts. So this is actually going to be a very helpful webinar for you. So I'm going to pass the baton back to Deb, and she can continue with the presentation.
All right. Well, it sounds like this, as Pam said, this will be a very applicable webinar for you. Let's look at the impact of the business. Now, in a later slide, I'm going to lay out 5 steps to follow to achieve compliance. But the primary impact to your business will be in the IT systems, which includes also accounting processes and your internal controls. Those will all need to be updated or at least reviewed to ensure compliance. You're going to have to look at your financial statements. Most of you probably already have this in hand, where you're actually looking at revenues, liabilities, and the timing. And if you're doing this in spreadsheets, you're already paying attention to this. In addition, you'll need to look at your tax planning, basic cash and non-cash, covenant compliance, and of course your sales compensation plans. And finally, this is something that always gets people, is that you have to create and deliver extensive new disclosures in documentation. You have to be ready for that for your auditors. Now, PwC produced a survey on February 20th of last year, where they asked their finance executives who participated what they experienced with implementing these new revenue standards and what challenges they're experiencing. So that said, let me move this forward. Here we go. 1/3 of the survey respondents expected implementation of these standards to cost over $1 million. Now, this is $1 million that includes the cost of using internal resources, but also dealing with IT system changes, and of course, bringing in external advisors. This can prove difficult to estimate fully, but that's, you know, that you want to look at the whole picture instead of just the external part, as to understand what the cost of compliance is. In addition, 44% of the respondents said that they're still assessing the impact of the new standard back then. Now, as those of you on the webinar, you're in the 76% category of assessing the impact, and you have to comply with the 2019 effective date. So you still have some time, but it's likely you still need to do some work around this. So on with the show, you have 93% at that time, and this is February of last year, expected to make a system or process change. So these are moderate to high process changes, and so you know, start now. This is quite an extensive process. Now, this is where Strafford comes in. The reason we again did this webinar is because we started to see that the downstream impact of systems such as Oracle EPM systems like HFM or FCCS, we started to see that the impact of the revenue standard change was trickling down to systems like this. So we thought we would try to go backwards and look at how we can help with this process. So adoption statistics are key for this. The accounting policy changes were pretty useful, 23%. Disclosures were in good shape. It was the process and/or system changes that the folks really had most challenges. So, in fact, in this poll, about twice the number of named systems and processes are more challenging than the other two issues listed. Important note, the key process change that we've seen within Strafford have been in the integration points. People are having to change the way they think about and the way they handle revenue across various systems, such as your point of sale system, your contract system, and of course the accounting system. So let's get into the meat of how you actually achieve compliance. These are the 5 steps I mentioned earlier. The 5 steps are: you have to identify all your material contract customers. Number 2, you have to identify your performance obligation within those contracts. Number 3, and this is the fun part, you have to determine the transaction price that's applied to your performance obligations, and we'll get into that too. Number 4, once you've identified that, you have to allocate that transaction price to the performance obligation within the contract. And then finally, number 5, you need to recognize the revenue when or as the entity satisfies a performance obligation. This last part basically significantly impacts those of you who are doing subscription revenue. So if you have something that comes in on a monthly basis, that's when you recognize the revenue, and the subscription has an endpoint, say, 1 year. So these are the 5 steps. We're going to go over them one by one. The first step is to identify your contract. The 2 criteria in order to determine if the contract is wholly unperformed is if both of these are met. First of all, you, the entity, or the company, when I say entity, that usually means the company, has not yet transferred any promised goods or services to the customer, and the entity number 2 has not yet received and is not yet entitled to receive any consideration or money in exchange for promised goods or services. So those are the 2 criteria. We have a handy table that we use to give you an idea of what a contract, what constitutes this contract. So a contract exists if a collection of consideration is probable, and consideration is defined as money due to the entity. In addition, it exists if it has commercial substance. Now, commercial substance is defined as that a company expects that a future cash flow will change as a result of a transaction. So if you have a large payment due, that particular contract has commercial substance. In addition, the distinct rights to goods or services and payment terms can be identified, and the contract exists if it is approved and the parties are committed to their obligations. Fairly straightforward, you would agree. However, I have another handy little yes-no table. I won't go through each of the components. We can certainly, you can review this in the recording later, or you can potentially ask the moderator to send you the block of slides at a later point. But in general, you go through these yes-no tables to determine if the standard applies to your contract. Then, contracts are not as simple and straightforward as I am going to purchase a widget and I'm going to pay the company for the widget. There's a bundling or there's a portfolio aspect to it. So you need to evaluate which similar characteristics constitute the portfolio. There could be any number of criteria associated, like periods of time, like I have in item number 1, or potentially geographic locations. And once you've identified whether you can portfolio a batch of your contracts, you also need to assess whether that portfolio approach is appropriate. And once you've identified those, whether you can use it or not, you then have to develop the back process and control in order to account for this portfolio, or I call it bundle of contracts. I have another handy yes-no table about the portfolio application to the standard. So again, you can take a look at it on a recording, and we can certainly have you pull it up later. Right. Now, you need to identify the combination of contracts that are likely to go into these portfolios. And so these key questions are crucial. First, you need to understand or determine if the contract has been terminated and if you've received the money or the consideration and you're not going to give it back to the customer. If yes, then you now identify this as revenue. Also, you want to look at whether there are any remaining performance obligations. Have you delivered your good or service, and have you received your money and it's not and you're not refunding it at all? This then gets identified as the revenue. Now, under US GAAP only, if the entity has stopped transferring goods or services and there is no obligation to transfer anything more, and all consideration or money received is non-refundable, if yes, then that's also considered revenue. Otherwise, the consideration received is a liability because you have to give that back. It's fairly straightforward there. So let's look at where we are on this. Now remember, this was February of last year. At that particular time, the 50% of the survey respondents for PwC said they had this step complete or under control. So this was the highly manual exercise. Everybody had to look at their contract system. They had to look at processes. This review drove needed system changes for tracking and needed process changes. This point could also include a discussion on the practice of bundling performance obligations as well. So they had to go through that and identify your distinct goods and services that would be satisfied over time. So this is not necessarily do it once and you're done. This is an identification of contracts is an ongoing thing. So when you're identifying your performance obligation, the performance obligation is different from an actual contract. It is defined as the unit of account for revenue recognition. So systems can actually pick this up as a rule and ensure that the performance obligation is identified and applied. So you have to assess whether the good or service promised in your contract is identified as a good or service that is distinct, or if you go for the portfolio approach, whether the bundle of goods or services is distinct. So in addition, the series of distinct goods or services that are substantially the same and have that same pattern of transfer to the customer. I sort of like to use an example of building a house as a bundle. So if you're going to contract to build a house, you're not going to go out and distinctly buy cement to pour the basement. You're not going to separately buy lumber unless you really want to do that stuff. But you're not going to buy separately lumber, drywall, paint, or any of that other stuff. You're going to contract to buy the house, and that's then all of those distinct obligations are bundled together. So if you keep the building a house example in mind, then we will look at how you can identify the distinct goods or service within the performance obligation. Now, in this case, a single contract may contain promises to deliver the customer more than one good or service. So you as a company will need to evaluate the promised good or service to determine which of them are distinct and therefore constitute the performance obligation. So we have two criteria to determine this distinctness, and they have to be combined together in order to come up with a yes/no answer. So the first criteria, is it capable of being distinct? Can the customer benefit from the good or service on its own or together with other readily available resources? And number two, is it distinct within the context of the contract? Is the entity's promise to transfer the good or service identifiable from the other promises in the contract? And those combined together, if you answer yes, you can identify your distinct performance obligation. If no, then it is not distinct and you combine with other goods and services, meaning you can probably bundle it.
Hey, Deb.
Yep.
Hey, this is Dave. Hey, on that last one, a good example to bring it home for people is buying, like say you buy a washer and a dryer, right? You know, those are distinct items, but then you also buy the service package to have it installed, right? So the company has to look at it to say, all right, is the washer dryer distinct on its own? You know, can I recognize that revenue? And am I outsourcing? I'll make Best Buy up. You know, that piece as a unique, separate, or is it bundled together? Most of the time, in that case, you know, they would be two distinct items because anybody can do the installation. They can outsource that versus your house example where it's all bundled.
Right. Yep. That's a very good example. Thank you for that, Dave. Now, finally, there's an area of identifying performance obligations that has an implied promise and a set of administrative tasks around that performance obligation. So we've laid out the two separate areas in this slide to cover what you need to do. If there is an implied promise to transfer a good or service, and it can be explicitly stated, and it is explicitly stated in the contract, then it is identified as a performance obligation. Or it can also be implicit based on established business practices. You can have a reasonable expectation that this particular good or service will be transferred to the customer. That would be identified as a distinct performance obligation. The implicitness basically usually means contracts that go out into the future, and could basically, if you say, if this event happens, then this performance obligation is required. An example could be some legal contracts. It could be that you have, if, for example, snow falls in the Northeast, then you have to plow the driveway. So that's sort of a future performance obligation that is distinct. However, administrative tasks do not transfer a particular good or service, and it's not distinct. So and we've used the example of setting up the contract as an administrative task. You cannot include that internal cost or the internal administrative cost to set up the contract within your distinct performance obligation. So this handy table gives you the idea of the formula for identifying your single performance obligation. A contract may contain promises to deliver the series that are substantially the same, that is, of the distinct goods or service. At the contract inception, you need to assess whether these series of goods or services is this single performance obligation. These are the criteria. You have to identify that the goods or services are substantially the same, that each distinct good or service in the series is a performance obligation satisfied over time. If it snows, the driveway will be plowed. The same method would be used to measure the progress towards satisfaction. All those together will constitute your single performance obligation. And this is where I would use the house, building the house example. So if you are building this house, you might split up the house payment process into several stages. Land, prep, and perk would go into stage 1, and you may end up having a revenue recognition or identified revenue transfer then. And you pour the basement and bring in piping, could be stage 2, and so on. Progress is measured by signing off at each stage, and revenue recognition can then be performed at the conclusion and acceptance of each stage. So that's just an example of what you might have to do in order to identify your distinct good or service. Now, there are some alternatives, and this is under US GAAP only. US GAAP entities are not necessarily required to identify promised goods or materials, services. They're immaterial in the context of the contract. In IFRS, you have to identify all promised goods or services, material or immaterial, in the context. And in US GAAP, you don't necessarily have to. So an example of this would be that if you purchase something from Amazon and they ship it out to you, the revenue is recognized for the item. Under US GAAP, you can elect to treat that shipping and handling activity as part of the fulfillment cost, which would then affect your gross margin or Amazon's gross margin. So the performance obligation is set up because you ordered something from Amazon, and then the customer obtains control of the item, but the shipping and handling costs made it happen. So as soon as the customer purchases the item, the revenue can be recognized, and the fulfillment cost, even though it hasn't happened yet, is also applied against the performance obligation. Now let's look at how far along people have come as of last year. Most of the 50%, which is a good number, have the step complete or under control. Again, this affects your contract systems, and this particular area also drives required system and process changes. Now, this is where performance obligations sort of adjust over time. You may deliver something slightly differently with your next contract. So this type of work, this type of identification work, is going to be ongoing beyond the initial implementation. So it's good to have a process behind it. Now, this area is step 3. You need to determine your transaction price. This will take most of your time, we believe. So a transaction price in this handy little table is defined as the amount of consideration to which an entity expects to be entitled in exchange for transferring goods or services to a customer, excluding amounts collected on behalf of third parties. For example, sales tax. The third party is the government. So let's look at the first one, the top left table, variable consideration and the constraint. What is variable consideration? Variable consideration basically is the amount that is variable when if you have a sales guy making a rebate or a price concession or a refund on the price, you need to take that into consideration. That's called the constraint. The transaction price also needs to include any non-cash consideration. Let's take that as an example of, let's say you have a stock exchange or a stock purchase or whatever as part of your contract. That's a non-cash consideration. And you have to basically measure that at fair value. In addition, if you have a significant financing component, this might be where the customer pays before or after the goods or services have been provided. This basically is, the customer may pay for a magazine subscription in advance of the magazine being delivered over the next year. And then finally, consideration payable to a customer. If the customer is paying for, whether consideration payable to this customer represents a reduction of the transaction price. So that's those four areas are what you need to go through and to determine your transaction price. There's an additional step involved in looking at the variable consideration. Management should use the method that best predicts the amounts of the consideration, and there are two ways of looking at it. There's expected value and most likely amount. The expected value is used if it considers the sum of the probability weighted amount for a range of possible consideration amounts. In plain English, this means that you have a lot of contracts that have similar characteristics, and you need to do an expected value analysis for your variable consideration. The most likely amount means that you probably have few contracts, one or two, so you probably have a pretty good idea of what the most likely amount of this variability is. So if you pick one, you kind of have to stick with one or the other. This is not necessarily a policy. You can't change your policy from 1 month to the next. Consistency is key, and consistency is what the auditors will look at. Go to the next slide here. Now let's look at progress to date on determining the transaction price. As of last year, 32 to 50% of the survey respondents said they had this step complete or under control. I imagine they would. It should be pretty direct as to what transaction price they've applied. This is something most companies probably have under good control. This is highly dependent on the contract assessment methodologies they use, and system changes to track those additional contract elements are also required. So once you identify maybe separate and distinct performance obligations, and you identify the steps around determining the transaction price, you have to make sure that all the attendant systems and internal processes are changed accordingly. Now this gets to step 4. Once you've identified your transaction price, you now must allocate this price to the performance obligation. And it consists of 2 sub-steps. Once you determine your standalone selling price, you allocate the transaction price. An entity generally allocates the transaction price to each performance obligation in proportion to its standalone selling price. So this is the 2-step model that we use to discuss this next table. There's a couple of areas around allocating the price. So if you have, say, your 3 standalone selling prices, performance obligation 1, 2, and 3, you want to determine that standalone selling price is an observable price available. If it is, great, use it. If not, you have 3 areas or 3 approaches that you can use in order to estimate that price. Let's start with the adjusted market assessment approach. Theoretically, this method estimates standalone selling price by estimating the price that the customer would pay for the good or service in the entity's market. Now, practically, this would include reference to the price an entity's competitors might charge for similar goods or services, and that's adjusted to reflect the entity's costs and margins. When I say entity, I mean you, the company. This is very similar to, the current US GAAP, and it's the second highest measurement method when determining relative selling price under current US GAAP. So most US GAAP folks use the adjusted market assessment approach. Let's look at expected cost plus a margin approach. Under this method, the entity estimates a standalone selling price by estimating expected cost to satisfy the performance obligations and then adding an appropriate margin. This is also similar to US GAAP under ASC 605-225, and but it is the lowest measurement method when determining relative selling price under US GAAP. So it's used, but not as much. And then finally, under a few limited circumstances, there is the residual approach. This one is estimated by subtracting the sum of all observable standalone selling prices of other goods or services promised from the total transaction price. This may only be used if one of the following criteria is met. Number one, there is a broad range of current selling prices to other customers, and thus there is no representative standalone selling price. Or number two, the good or service has actually never been sold, so there is no established price for the good or service. Moving on. So let's look at the progress to date with this piece of the 5-step process. So most of the PwC survey respondents, or at least half of them, say they have it complete or under control. Identifying the transaction price and allocating the price is sort of a hand and glove process. Now, step 5, you now go ahead and recognize this revenue. As long as all steps 1 through 4 are satisfied, you would basically evaluate if the control of the good or service is transferred at a point in time, or if it is transferred over time. And that's fairly straightforward. So once you've got all the rest of the steps done, this one should be a slam dunk, at least we hope so. Now, we wanted to look at which industries are most affected by this revenue standard change. And if you notice, the software and services line has to go through all of this stuff. They have subscriptions, they have a lot of your other areas, they have revenue that comes in over time, and so on. The next areas most affected are licensors, such as franchisees, media companies, sciences. They have, again, this sort of future aspect of revenue coming in over time. So whatever the industry, every industry appears to be affected in some way. So at this point, we'd like you guys to take another poll. I'll turn this over to Pam.
Great, thank you, Deb. So here's our final poll. Please take a minute to answer the following question. What are the biggest challenges you face in IFRS 16 ASC 606 compliance? Your options are difficult to identify the contracts with customers, challenges in determining standalone selling prices, difficulty in handling mid-cycle changes to contracts, assets, and services, or other. So 35% of you mentioned that they have difficulty in handling mid-cycle changes to contracts, assets, and services. And other than that, 47% are other. So it'd be interesting if you want to use the Q&A section to tell us what your challenges are. It'd be great for us to understand so that we can maybe answer them after the presentation. I'm going to hand the presentation over to Dave, who's going to give you some examples.
So what I wanted to do is kind of tie these concepts together that Deb was talking about. So I have 4 examples that I'm going to go through, and they basically, the first one is identify the contract. The second one, we'll talk about the performance obligations, what's bundled, what's distinct. The third one is about a contract asset, and then a contract liability. So let me start off with this one, identifying a contract. So I'm an accountant, so I like my debits and credits. So I did this like if we went back to school and made up some scenario. So on this one, on March 1st, 2017, the Mango Company enters into a contract, and they're going to transfer the product to Sunun on July 31st. Okay, The contract is structured that Sunun is required to pay the full contract price of $5,000 on August 31st. The total cost of the goods is $3,000, and then Margot delivers a product to Sunun on July 31st in 2017. So what I did was, to the right is these are what journal entries does Margot Company make in regards to the contract? So the first thing is, you notice on March 1st, right? There is no revenue recognition going on there, okay? So the first transaction is going to be on July 31st. That's to record the sale and related costs, because on July 31st, that's when the contract is structured, and so we can do that. The cost, I had made the estimate that they went through all the revenue recognition and costing rules and everything else, so we just made up some cost and then put the inventory on the side of it, so that you can see the debit to accounts receivable, the credit to the revenue, and then the cost of goods sold and inventory. And then on August 31st, when they actually paid for their service, then the company, Margot, can then record the cash on hand. All right, so that's so basically what I wanted to do is putting what we've learned together into a journal entry presentation so that you can see this. So let's go to the next slide. Now, on this illustration, what I'm going to try to do here is understand the performance obligation. So we'll just walk through this made-up company. So Softtech licensed customer relationship software to Lopez Company. And then in addition to providing the software itself, Softtech promises to provide consulting services to these guys as well, and the consideration is going to be $600,000. Here, go back one slide, where we jumped ahead here. Yep. So anyway, so they're going to provide the software. They're going to customize the software, and then the consideration is $600,000. So what's going to happen here? So in addition to the software customized by Softtech in accordance with the specifications negotiated by Lopez. Okay, so what I wanted to illustrate here, so do these facts describe a single or separated performance obligation? So this is taking one of the concepts of the performance obligations and putting into practice. So because these services and software are highly bundled, I mean, so they could be considered two distinct things, but because they're put together to perform one performance obligation in this case. So that was the example here, is that we're taking two distinct things. We're taking the sale of the software, as well as we're bundling the consulting services that are going to highly customize this, and that's considered, one distinct obligation. Okay, go to the next slide. So on this example, what we'll do is, so on January 1st, the Finn company enters into a contract to transfer product A and product B. So there's two products that they're going to transfer to this Obermein company for $100,000. So the contract specifies that the payment of product A will not occur until product B is also delivered. So in other words, it won't occur until both products are transferred to Obermein. So the Finn determines that the standard prices are $30,000 for product A and $70,000 for product B. Finn delivers product A to Obermein on February 1st in 2017. And then on March 1st, 2017, Finn delivers product B to Obermein. So what journal entries need to happen? So on January 1st, when they enter into the contract, no revenue has been transferred yet because we haven't performed any obligations. So on February 1st, to record the contract asset. So when they deliver the first product A, we can put on our books the $30,000. So that's the sales revenue credit, and then the contract asset debit. And then on February 1st, then does not record the accounts receivable because it didn't have an unconditional right of the 100,000 unless it transfer, because it didn't transfer both products yet. So then on March 1st, once everything's been, they have everything, then they can recognize the accounts receivable, and then what they'll do is they'll credit the contract asset and then credit the revenue. So again, this is another example of applying the rules. So what we do at Strafford is we walk through the rules and we make sure that the accounting is set up in their current applications, so that we are good to go. Okay, the next example. So in this last example is for the contract liability. So on March 1st, the Henley company enters into a contract to transfer a product to Propel Incorporated. On July 31st, it is agreed that Propel will pay the full price of the $10,000 in advance on April 15th. And then Henley delivers the product on July 31st. And the cost of the product is estimated at $7,500. So what happened? So on March 1st, there is no transaction yet because nothing has hit the books. So on April 15th, we record the cash that we get. And if you notice the unearned sales revenue, some companies have that set up in their chart of accounts and some companies don't. So that's a common one based on this new rule that we've seen that we may or may not help people set up so that we can, keep your T accounts, as they say, in order. So then what happens? So then on July 31st, we, they satisfy the performance of the obligation. They delivered everything. So then we can then debit the $10,000 for the unearned sales revenue and then credit our sales revenue. So we claim our cash. And then the same thing with our goods that were estimated. So we'll credit our inventory and then debit our cost of sales. So I just wanted, again, so this is just taking some real life examples of what Deb was presenting and applying it. Now I know each company is a little bit different. So depending upon your situation, you may or may not, need to add new accounts to your chart and so on and so forth. So with that, I'll hand this back over to Deb.
Thank you, Dave. These are very cogent examples. Again, you can review them in more detail via the recording or ask to see a copy of the slide deck. In any event, really the high-level impact of the standard to your revenue, your current revenue recognition process, are that really it's the new standard applies to your company's contract with your customers. As the key process, you kind of have to separate things out into this unit of account. You have to identify your performance obligation, and a unit of that performance obligation is slightly different than a contract. A contract, and I may be simplistic here, but a contract is defined as it could be a single performance obligation or a batch of performance obligation, all under one umbrella. Then you allocate your transaction price to the distinct performance obligation within this arrangement, and then you can recognize your revenue when it is satisfied by each performance obligation. In addition, the costs of obtaining this contract can be capitalized if they are expected to be recovered and amortized as a performance obligation. That doesn't always occur with each contract, but if you do have that situation, they certainly can be recovered. Now, number 6, the entity can apply this new revenue standard retrospectively, and these are this is one of the bigger stumbling blocks we've noticed. So you can do this retrospectively, where you restate your prior periods presented as though the new standard were already in place from the beginning of the required deadline. Or you can choose to recognize the cumulative effect of applying it to existing contracts. However, you have to know the opening balance of retained earnings on the effective date, and you have to supply the proper disclosures. So items 1, 2, and 6 on this list have been really where people spend the most time in attempting to ensure compliance. So going there. Now, we've been telling you what to do all along in order to achieve compliance, and we wanted to ensure that you also understood what the impact of if you're not compliant. Now, first and foremost, publicly traded companies, they all must comply. There's no getting around that. However, for the rest of you who are not publicly traded, a bad audit can affect you as well. You will then receive more frequent audits if you have a bad audit. You may potentially lose customers, and then you will not be able to get good credit ratings or credit rates when you want to pull capital and expand your business. And then finally, you are required to deliver these disclosures. So we thought we'd put a handy little list together here for you. The required disclosures, you have to basically the revenue recognized from contracts with customers, and you have to have the revenue disaggregated into the appropriate categories. So you're going to spend some time there. You have to disclose your contract balances, which includes the opening and closing balances of receivables. That could be a fairly easy step, but also these contract assets and contract liabilities, even if they haven't really happened yet. And you have to disclose your performance obligations, and even when it's satisfied, and even when the transaction price is allocated to the remaining performance obligations in this contract. You have to disclose that. So when you get a contract, you kind of have to go through it with a fine-tooth comb. You have to disclose if you've made a significant judgment or a change in your judgment in application of these requirements to those contracts. And finally, you have to disclose any assets recognized from the costs to obtain or fulfill a contract with a customer. So these disclosures, if you don't already have them set up, this will be the area where you'll be spending some time doing that. So in conclusion, the primary impact of these new standards that the revenue recognition standard needs to reflect the associated obligations, the timing, and the amounts. And these affect your company's systems and processes, and also your disclosures, and you have to do some additional estimating work. This does not affect how you pay your compensation. However, I would suggest that your sales compensation and marketing initiatives would be significantly affected, and you probably would need to address these as well. So with this, we thank you for your time. And if any of you have any questions, you can submit them now. And I'm going to turn this back to our moderator, Pam.
Thank you. Thank you, Deb and Dave. This is some great insight that we've given everyone. We're running a little late, so unfortunately, we've got a few questions in, and we don't have time to answer them. So what I'm going to do is I'm going to put them into a separate doc and answer the questions and just include them with our follow-up. That also includes a link to the recorded webinar as well as the slides. So I just wanted to thank everyone. I'm confident that everyone on the call is going to crush any audit that comes their way because they will be compliant. Yeah. And I also want to thank everyone for their questions. And of course, again, we'll be sending a link to the on-demand version of the webinar as well as your CPE credit certification in a few days. For those of you who are high-hearing users and you'd like to learn how to apply these standards within your HFM environment, Deb and Dave will be able to talk to you, and we'll give you some information on how you can reach out to them to get a little bit of consultation from them. We are Strafford. Check us out at strafford.com. And just as a reminder, as you exit, you will get a survey. Please take a moment to complete it. So long and have a great day.